Welcome to RBC's Markets in Motion podcast, recorded September 23rd, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, weakness in homebuilders doesn't bode well for the recent outperformance of small caps. Second, we've continued to see some slippage in earnings sentiment, the rate of upward EPS estimate revisions for the S&P, which has been driven by companies outside of the biggest market cap names. Third, bulls picked up sharply in the AAII survey last week. Fourth, our work on U.S. equity market performance in the 12-month period following non-recession-related Fed cuts and reset cuts highlights upside risk to our 2H26 S&P 500 price target of 7,100. Fifth, Capex growth improved in 2Q25. And sixth, U.S. equity funds flows bounced back last week, driven by US-domiciled funds and retail investors in particular. If you'd like to hear more, here's another 6 minutes. We'll start with takeaway number one. Weakness in homebuilders does not bode well for small caps. Through Friday, the S&P 1500 homebuilders sub-industry was down more than 7% from its early September high. In recent years, when we've gotten a lot of inbound questions on small caps, we've also tended to get questions on homebuilders, and that's been the case again over the past few weeks. This time around, we think it's because both have been viewed as ways to play Fed cuts. With this in mind, we took a look at Russell 2000 performance relative to the S&P 500 and compared it to the S&P 1500 homebuilders performance relative to the S&P 1500 itself. Both of the calculations used a relative ratio. The two time series have mostly moved in sync with one another since early 2024, at least until recently. Homebuilding performance, interestingly, did hit a high relative to the broader market in early September and then began to underperform. But the RTY-SPX ratio has continued to move up as small caps have continued to lead. Note that RBC Capital Markets homebuilding analyst Mike Dahl has maintained a cautious view on the homebuilders, and from our seat, our industry-level work suggests valuations for the household durables industry, which contains the homebuilders, lacks appeal, and earnings revisions have also been weak. Moving on to takeaway number two, the earning charts that's still bothering us. We continue to see some slight slippage in the rate of upward EPS estimate revisions for the S&P 500 in last week's update. Digging in deeper, the slippage has been generated by deteriorating trends in the S&P 500, excluding the top 10 market cap names. The rate of upward EPS estimate revisions has continued to strengthen for those top 10 names, and that helps explain the resurgence in leadership of those biggest market cap stocks and growth stocks generally in recent trading. Overall, this divergence in earnings sentiment is a negative data point for the broadening leadership thesis. Next up, takeaway number three, bulls bounce back. Net bulls on the weekly AAII survey improved in last week's update. As of September 18th, the weekly data point for net bulls was back to minus 0.7%, while the 4-week average was back down to minus 9.43%. For now, the 4-week average is still in the minus 1 to minus 2 standard deviation range that has historically been followed by a plus 15% 12-month forward return in the S&P 500, but the weekly data point is not. We've spoken at several group events for institutional investors over the past few weeks, in which one of our colleagues has asked those who expect stock prices to be higher by year-end to raise their hands. Most of the hands in the rooms have gone up. While the AAII survey is of individual investors, we think its latest move also seems to be capturing the shifting mood of institutions. Moving on to takeaway number four, fear of fighting the Fed. This week, we're highlighting a new chart that examines S&P 500 performance in the 12-month period before and after different kinds of Fed cuts. Stocks tend to move up in the 12-month period following cuts unless the cuts occurred during or before a recession. Reset cuts, those after a long pause within a cutting cycle, have a median 12-month forward return of 13%, while non-recession cuts tend to have a median 12-month forward return of 21%. Overall, the analysis does highlight some upside risk to our 7,100 second half 2026 S&P 500 price target. Next up, takeaway number five, checking in on Capex. The time we spent at RBC's industrial conference last week and the recent uptick in ISM new orders made us curious about how the latest Capex stats are tracking for the S&P 500 and other indices. Capex growth moved up in 2Q25 for the S&P 500, the S&P 500 x the top 10 market cap names, as well as the Russell 2000 and mid-cap indices. Inclusive of the top 10 names, S&P 500 Capex growth is close to past highs, but excluding those names, it's well below them. It remains to be seen whether the provisions in this year's tax bill will spark a big wave of Capex in the coming years. The good news is that trends are already on the mend outside the top 10 S&P 500 names, and ISM New Orders, which has been a good leading indicator of actual Capex growth in recent years, has moved back into slightly positive territory. That being said, commentary on Capex and the One Big Beautiful Bill has been light in recent earnings calls, and survey data on Capex plans has been mixed. We're also mindful that Capex growth peaked in early 2018, another time when corporate uncertainty around tariffs was elevated. And we'll wrap up quickly with U.S. retail roars. We've been writing a lot in recent weeks about how flows to U.S. equity funds have deteriorated in recent months. Last week, flows bounced back. Interestingly, passive retail flows to U.S. equity funds, which had weakened a bit in recent week, also bounced back last week. At the same time, flows stayed weak to non-U.S. domiciled equity funds. There was a sharp move, however, in flows to U.S. domiciled U.S. equity funds. In other words, what we saw overall in the data is that last week's improvement in U.S. equity funds flows appears to have been driven by U.S.-based investors and retail investors in particular. That's all for now. Thanks for listening, and please reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.